What if the recent silver crash wasn't a failure, but a setup for what comes next? While panic sellers rushed for the exits, something far more significant was unfolding beneath the surface. Stay with me, because what I'm about to show you changes everything about how strategic resources are being valued in the new global order. While many market participants were fixated on short-term fluctuations in silver and gold valuations, something considerably more significant has been developing, a fundamental transformation in how strategic resources are being assessed and controlled globally. Recent declines in silver prices were not the result of deteriorating fundamentals. They were triggered by positioning dynamics, leverage unwinding, and temporary market mechanics. When trading positions become overcrowded and leverage ratios expand, even minor adjustments, such as stricter margin requirements or changes in market sentiment, can trigger forced liquidations. That type of movement eliminates overleveraged participants, but it does not necessarily indicate that the underlying long-term thesis has been invalidated. Silver continues to function as an indispensable industrial metal. It remains essential for electronics manufacturing, photovoltaic solar panel production, medical equipment, and sophisticated defense technologies. What numerous analysts consistently overlook is that silver is predominantly extracted as a secondary product during the mining of copper, lead, zinc, and gold. This structural reality means silver supply cannot be rapidly expanded simply because market prices increase. Supply remains fundamentally constrained by the economics of primary metal extraction. Simultaneously, governments across the globe are progressively treating critical materials as matters of national security rather than mere commercial commodities. Rare earth elements, energy infrastructure components, and advanced materials are no longer viewed simply as tradable goods. They are recognized as strategic inputs vital for contemporary economies, defense capabilities, and technological advancement. China presently controls the overwhelming majority of rare earth processing capacity worldwide, which has generated substantial concerns among nations that depend on these materials for military hardware, electric vehicle production, artificial intelligence infrastructure, and advanced manufacturing operations. In response to this concentration of processing power, the United States and its strategic partners have been actively working to reconstruct domestic supply chains, incentivize local processing capabilities, and diminish reliance on foreign supply bottlenecks. This represents a sustained strategic initiative focused on long-term economic and security resilience rather than temporary political maneuvering. When governmental authorities classify materials as strategically critical, fundamental market dynamics undergo transformation. Price considerations become subordinate to availability and supply security. This evolution creates sustained demand visibility for corporations engaged in domestic production, processing operations, and infrastructure development. Government procurement contracts do not exhibit the characteristics of speculative markets. They prioritize consistency, reliability, and continuity of supply over price optimization. This identical transformation is manifesting across energy and electrical power infrastructure sectors. Artificial intelligence systems, data processing centers, and modern defense platforms require enormous quantities of reliable electrical power. As existing grid capacity struggles to accommodate expanding requirements, investment capital is flowing toward power generation expansion, grid modernization initiatives, and energy security enhancement. Advanced AI systems do not operate solely on semiconductor chips. They fundamentally depend on stable, abundant energy supplies. Gold and silver have not experienced fundamental failure as asset classes. Their established roles as both monetary stores of value and critical industrial inputs remain structurally intact. Short-term price volatility primarily reflects the unwinding of excessive leverage positions, rather than any collapse in the underlying long-term demand drivers, such as escalating geopolitical tensions, expanding fiscal uncertainty across major economies, and persistent industrial consumption requirements. What market observers are witnessing represents sector rotation and capital reallocation, rather than systemic market chaos or collapse. Investment capital naturally migrates towards sectors and opportunities where government policy support, structural supply constraints, and strategic necessity converge and align. Overall markets can experience significant volatility, while specific sectors simultaneously demonstrate strong performance characteristics. These dynamics are not contradictory. They reflect the natural process of capital seeking optimal risk-adjusted returns within changing macroeconomic conditions. The critical element is understanding appropriate investment timeframes and holding periods. Strategic materials and infrastructure-related opportunities are not suitable for short-term trading approaches. These represent position-based investment opportunities, fundamentally driven by deliberate policy decisions, comprehensive supply chain realignment initiatives, and sustained long-term capital investment cycles. Market volatility is an inherent component of this developmental process, not a definitive signal indicating the need for panic-driven portfolio liquidation. If investors wait for complete clarity and certainty before taking positions, they typically end up paying substantially higher entry prices. Genuine investment opportunities characteristically emerge during periods of elevated uncertainty, when news headlines generate maximum noise and emotional responses dominate market participant behavior. The fundamental objective is not to react reflexively to fear-based narratives, but rather to develop understanding of where governmental authorities are systematically creating structural demand and where sophisticated institutional capital is establishing strategic positions. This commentary does not constitute financial advice or investment recommendations. All financial markets inherently carry meaningful risks of capital loss. However, developing comprehensive understanding of policy direction, recognizing structural supply constraints, and tracking institutional capital flows provides investors with an analytical framework enabling strategic thinking rather than emotional reactivity to short-term price movements. Let me expand further on why these structural shifts matter more than temporary price volatility. The global economic landscape is undergoing a fundamental reorganization that has been accelerating since geopolitical tensions intensified. Nations that previously relied on globalized supply chains and assumed perpetual access to critical materials are now confronting the reality that supply security cannot be taken for granted during periods of strategic competition. The concentration of processing capacity in single geographic locations creates vulnerabilities that governments are now actively working to address. This is not merely about reducing dependence on any particular nation. It reflects a broader recognition that economic resilience requires diversified, secure supply chains for materials deemed essential to national interests. When supply chains become matters of national security rather than commercial optimization, the calculus governing investment decisions fundamentally changes. Consider the implications for companies operating in strategic sectors. Traditional market analysis focuses heavily on quarterly earnings, profit margins, and competitive positioning within existing market structures. But when governments designate certain industries as strategically vital and commit to supporting domestic capabilities, regardless of short-term cost considerations, entirely different investment dynamics emerge. Government support can take numerous forms, including direct subsidies, preferential procurement contracts, regulatory advantages, trade protections, and infrastructure investments that lower operational costs. These policy-driven tailwinds create sustained demand visibility that conventional market analysis often underestimates. A company producing strategically critical materials domestically may not be the lowest cost global producer, but if government policy prioritizes supply security over cost optimization, that company benefits from structural demand that persists regardless of cyclical economic conditions. This represents a fundamentally different risk profile compared to purely commercial operations, exposed to global price competition. The energy sector provides another clear example of this transformation. The explosive growth of artificial intelligence and data processing creates unprecedented electricity demand. Training large language models and operating massive data centers requires power consumption equivalent to small cities. As AI capabilities expand and deployment accelerates, electricity demand will continue growing substantially. This is not speculative projection. It reflects the physical requirements of computational infrastructure that governments and corporations are actively building. Existing electrical grids in many developed economies are already operating near capacity during peak demand periods. Adding substantial new load from AI infrastructure, electric vehicle charging, and industrial electrification creates urgent need for generation capacity expansion and grid infrastructure upgrades. These are multi-year, capital-intensive projects that require sustained investment regardless of short-term economic cycles. Governments recognize that energy security and grid reliability are fundamental to economic competitiveness and national security. Modern economies cannot function without stable, abundant electricity. Military systems, communications networks, financial infrastructure, and critical services all depend on reliable power. This creates bipartisan political support for energy infrastructure investment that transcends normal election cycles and partisan divisions. Capital flowing into power generation, grid modernization, and energy security benefits from this policy support and structural necessity. These are not speculative investments dependent on favorable market sentiment. They address fundamental infrastructure requirements that must be met for economies to function and grow. The time frame for these investments is measured in years and decades, not quarters. Returning to precious metals, the recent volatility illustrates how leverage and positioning can temporarily override fundamentals. When silver prices rose sharply, speculative interest increased significantly. Traders using leverage and derivatives piled into positions, expecting continued appreciation. As positions became crowded and leverage ratios expanded, markets became increasingly sensitive to any catalyst that could trigger unwinding. Margin requirement increases serve as that catalyst. When exchanges raise the capital required to maintain leveraged positions, traders must either deposit additional funds or liquidate positions. In crowded trades where many participants are similarly positioned, forced liquidation creates cascading selling pressure that pushes prices down rapidly. This mechanical process reflects positioning and leverage rather than fundamental changes in supply, demand, or industrial usage. Once the leverage is flushed from the system and weak hands are eliminated, prices can stabilize and fundamental factors reassert influence. Industrial demand for silver continues regardless of speculative positioning. Electronics manufacturers, solar panel producers, and medical equipment companies require silver to maintain production. The demand provides a fundamental floor beneath prices once speculative excess is cleared. The same pattern has played out repeatedly across different markets and asset classes. Leverage amplifies moves in both directions. Rising prices attract speculative capital and leverage, which accelerates gains. But leverage also creates fragility. When sentiment shifts or margin conditions tighten, the same leverage that amplified gains now amplifies losses. The violence of the move down often matches or exceeds the preceding rally, creating the impression that fundamentals have collapsed when really only positioning has changed. Understanding this distinction is crucial for maintaining perspective during volatile periods. If industrial demand remains strong, supply remains constrained, and long-term drivers remain intact, then price corrections driven by leverage unwinding represent potential opportunities rather than permanent destruction of value. The challenge is distinguishing between temporary technical selling and genuine fundamental deterioration. Government policy provides important signals about long-term demand trajectories. When authorities classify materials as strategically critical, implement export controls, provide subsidies for domestic production, or establish procurement preferences, they are revealing their assessment of long-term importance. These policy actions create structural demand and reduce market-driven volatility because government purchasing decisions prioritize security and reliability over price sensitivity. Strategic materials benefit from this dynamic in ways that purely commercial commodities do not. A government committed to securing domestic supplies of critical materials will continue purchasing regardless of short-term price fluctuations. That creates demand stability and floor prices that limit downside during periods of speculative selling. It also means that supply constraints have more pronounced effects, because substitution and demand destruction mechanisms work differently when buyers prioritize availability over cost. The investment implication is that strategic sectors can offer more resilient return profiles during volatile periods compared to purely cyclical industries. Government support and structural necessity provide ballast against market turbulence. This does not eliminate volatility entirely. Markets will still experience fluctuations driven by sentiment, positioning, and macroeconomic factors. But the presence of policy support and strategic importance creates boundaries around volatility and improves risk-adjusted return potential over appropriate timeframes. Sector rotation is a normal feature of functioning markets. Capital constantly seeks optimal risk-adjusted returns, which means money flows into and out of different sectors as conditions change. Currently, capital appears to be rotating toward areas where policy support, supply constraints, and strategic necessity align. This includes critical materials, domestic manufacturing, energy infrastructure, and defense-related technologies. These sectors benefit from tailwinds that are structural rather than cyclical. Volatility during rotation periods can be intense because major capital flows take time to complete. Institutional investors cannot instantly shift large positions without moving markets. The transition period creates price instability as selling pressure in declining sectors coincides with building demand in favored sectors. For individual investors, this volatility creates both risk and opportunity depending on positioning and time frame. The essential skill is separating signal from noise. Market headlines, daily price movements, and short-term sentiment shifts constitute noise. Policy decisions, supply chain developments, and long-term capital investment trends constitute signal. Focusing on signal while filtering noise enables strategic positioning rather than reactive trading based on emotional responses to temporary conditions. Perfect clarity never exists in markets. Information is always incomplete, future outcomes remain uncertain, and multiple scenarios remain plausible at any given moment. Waiting for certainty before acting means waiting until trends are obvious to everyone, which typically corresponds with elevated valuations and reduced opportunity. Taking positions during periods of elevated uncertainty, when headlines generate fear and prices reflect pessimism, historically provides better risk-reward opportunities for patient capital. This does not mean blindly buying during every decline or ignoring genuine risks. It means developing frameworks for assessing whether current conditions reflect temporary volatility or permanent impairment. Analyzing policy direction, supply fundamentals, demand drivers, and capital flows provides that framework. When these factors remain supportive despite price weakness, disciplined accumulation during volatility often proves rewarding over appropriate timeframes. Risk management remains essential regardless of conviction. Markets can remain irrational or volatile for extended periods. Leverage should be avoided or used extremely conservatively. Position sizing should reflect genuine risk tolerance and time horizon. Diversification across uncorrelated strategies provides stability during turbulent periods. The current environment presents complex dynamics. Inflation pressures, interest rate uncertainty, geopolitical tensions, and policy shifts create genuine volatility across asset classes. But within that volatility, structural trends are developing that will likely persist for years. Strategic materials, energy security, domestic supply chains, and infrastructure modernization represent multi-year themes supported by policy commitment and fundamental necessity. Understanding these themes provides context for evaluating shorter-term volatility. Price declines in strategic sectors driven by positioning and sentiment may represent opportunities to establish or add to positions at more attractive valuations. Conversely, rallies driven purely by momentum and speculation without fundamental support warrant caution regardless of price direction. Follow the fundamentals that drive long-term value creation. Follow the policy signals that reveal governmental priorities and create structural demand. Follow the capital flows that indicate where sophisticated investors are positioning for multi-year horizons. Filter the noise generated by daily price movements, emotional headlines, and short-term positioning dynamics. This approach does not eliminate risk or guarantee returns, but it provides a framework for strategic thinking during uncertain periods when opportunity and risk coexist in complex patterns.